Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 16th, 2023. I hope you're doing well. I appreciate you coming and visiting me this weekend for my weekend review podcast. Boy, what a week we had in the market. Big surprises during the FMOC meeting, and the market just took off like crazy. I hope you had a good week. I hope you're trading well. And the format for the podcast today is as follows. First of all, we're going to run that U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week, both on the daily and the weekly time frames. We are going to talk about when I entered them, why I entered them, what was the setup, what was the strategy, and most importantly, how I am going to manage the trade going forward, either to the upside or to the downside. After that, we are going to talk a little bit about trader psychology. Always in my opinion, the most important skill in trading is the ability to create a plan, create a process that has a good risk to reward ratio, that has a good setup, and then to follow that process regardless of what happens, either to the upside or the downside. In trading, it's very important to have a process that gives you that good risk to reward ratio, because that, when it comes down to it, that is the most important part in trading. Is if you're wrong, being able to know, having a defined risk in the worst case scenario, and then most of the time having a small loss with the potential of having a small gain, or even better, a large gain. And hopefully today, as I show you my trades, you will see they're not all positive, but over time, if you've been watching this channel for a while, you will see that the trades that I lose on are generally small, but the trades that I win or have winning trades on have the potential for some big outsized gains. And so the trades that I have, generally small losses, potentially big winners, and that's what I'll show you today. And that's really what trading is about: being patient, waiting for a setup, position sizing correctly, good risk to reward ratio, and then if you're right, potential for a big outsized gain. If you're wrong, small loss, because you're going to have them. But you'll see over time that if I am in a trade for any length of time, it's because it is a winning trade. And if I'm in a trade that was a loser, I am generally out quickly. All right, so we'll talk about trader psychology, about having that plan, creating that plan, being patient, following that process. And then after that, I have gone down through my watch list, both on the daily time frames and the weekly time frames, and I have identified some potential setups for next week that I'm interested both daily and weekly. It's important. My process is on the weekends. I go through, look for what I'm looking for next week, and if they get to those levels, if those are attractive levels that give me a good risk to reward ratio, there's a confluence combination of signals lining up, that's when I take the trade. If they don't get there, I just don't take the trade. I just move on to another market. You know, with this rally that we've had here in this particular podcast, I probably have the fewest amount of potential setups for next week, because so many things are overbought right here. And in my opinion, I'd be very careful about entering new positions here with this basically vertically up move. That's vertical up moves are generally there's a lot of red flags associated with them. So be careful. Don't get caught up in the FOMO. If you have long positions, that's great, but make sure that you have a plan to know that if they turn against you, you have some level where you go, okay, this was great. I'm going to get out here. Things don't go straight up. They don't go straight up. And just when everyone gets so one-sided and thinks, oh, this is it, we're going up forever, in my experience over trading for 28 years, that is about it. So if you have positions, wonderful, but make sure you have a level that if it starts to go down, that you get out, because in my opinion, in the near future, we probably are going to have a pullback. And as a matter of fact, today in the podcast, I'm going to show you several charts of why I am seeing that we are probably near a short-term top in the market. All right, so that's the plan. Let's get started. I'm going to run the U.S. legal disclaimer, and I will be back very shortly in about 40 seconds. Thank you so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. Let's take a look at the trades I made last week. If you're new to this channel, after watching, you may say, boy, Greg has a lot of rules in his trading, and I do. And every single rule I have there is really for a reason. I've been trading for 28 years, and it's taken me 28 years to put together my process of what I do. If this happens, I'm going to do that. If that happens, I'm going to do this. So you may think, boy, there's so many rules. How would I ever learn that? Well, just to start off, just to let you know, I do teach private one-on-one lessons in the evening time via Skype. I've taught for many, many years. I've taught people from all around the world, from absolute beginners all the way up to hedge fund managers. So if you are interested in learning the skill of trading, I have a great course. It's a one-on-one course in the evening time via Skype, 15 hours. I teach you all of the 5 trading approaches that I use. I teach you step by step every single rule. And by the time you are done with that course, I promise you are going to be a better trader. So if that's of interest to you, just go ahead and send me an email. Email is in the link of the YouTube video, and we can get a discussion started. Okay. All right. Let's start out with Caterpillar. Okay. Well, Caterpillar has been a monster trade, everyone. I entered Caterpillar all the way back here on the 1st of November. Now, when I am looking to enter a trade, ideally, I'm looking for a combination or confluence of indicators lining up. The more indicators and the more signals that you have, the more likely that you are going to have a winning trade. Not always, but it really dramatically increases your ability to have a good trade if you look for those confluences of indicators. So here I got long at 231.60. Why would I do such a thing? It looked pretty bad down here, right? Well, this is a deep dip buy strategy, and multiple indicators lining up. First, you can see the orange line here. This is the 300-day moving average. This is a key level. And on the day that I bought it, you can see the previous day it closed below the 300 and then closed above the 300. But I talk about having confluence of signals. It also went under the 30 RSI, over the 30 RSI. On the same day, it closed back over the 300-day moving average. In addition to this, you can see I have this colored blue. Why would I do that? This is what's called an island reversal bar. This is a very strong signal. They don't always work, but I'm going to show you multiple times today the power of these setups. So the combination confluence of setups were as follows. We closed under the 300, we closed over the 300. We went under the 30 RSI, we closed over the 30 RSI. So when I first get into a trade, it's very important that you position size based upon the volatility. Clear signal, close under, close over the 300, close under, close over the 30 RSI. Those are the signals, but how many shares do I buy? Well, that is a function. I have a formula that I use, and I take 1% of my total account value. So let's just say we have a $100,000 account. 1% is $1,000. I take $1,000, I divide it by the value of the 2 ATR. Right now it's 1035. It was not that back when it was here, but let's just use this because this is the current, divided by 1035 would tell me to buy 95.2 shares. So round it down to 95 shares. That is the correct amount of shares to buy based upon the volatility of the last 20 days. So my signal is under 30, over 30, under 300, over 300, boom. That's my entry signal. Now, I do the math on how many shares to buy. There we go, 95.2. Now, the next thing I do is you can see the red line down here. This is exactly 2 ATRs or 1035 below my entry. So if I have 95 shares and it moves $10.35 to the downside, that is my emergency stop. That's where I say, okay, I'm completely wrong. Very, very unlikely it's going to get down there, only about a 5% chance. But if it does get down there, I'm just going to get out for my 1% loss. Now, as I mentioned, that only happens 5% of the time. The other 95% of the time, when you do have a losing trade, it will be your end of day stop. Well, end of day stop is generally, why did I get into the trade in the first place if it reverses? Well, I got in because it went under 30, over 30, under 300, closed over 300. So in the future now, if it closes under the 300, that is my end of day stop. Even if it closes 1 penny underneath, I will simply be out for a very small loss. Okay, now I have an orange line up here. What is that? That is my trailing stop level. So if it moves 1.5 ATRs above my entry, then I get into trailing stop mode, which simply means if I get a close below a previous bar's low, I will get out of half. It's a precautionary measure. Now, in addition to that, I always take partial profits as we move up from the previous day's close. Right now, and that's 0.45 ATRs. Right now, the value is 0.45 is 233. So I take it every day from the previous day's close. So currently, the previous day's close is 285.74. I would add the value of the 0.45 to it, plus 2.33. For Monday, my first profit target is 288.07. Okay, 285.74 plus the value of the 0.45 of 233 is 288.07. That's my first profit target. Then I take my first profit target, I add the value again, 233. My second profit target for Monday is 290.40. And then that's my second profit target. Now I take my second profit target, add it again, 233. Those are my 3 profit targets for Monday. And you might ask, well, how much are you taking off at those profit targets? 10% of the remaining shares that I have. So the position sizing is defensive. The emergency stop is defensive. The end of day stop is defensive. The trailing stop level is defensive. These are all defensive moves, but I also have the offensive part of trading, which is the taking partial profits as it moves up from the previous day's close. All right, so hope that makes sense. So, okay, so let's kind of regroup, start all over now. Under 30, over 30, close under 300, over 300, boom, there's my signal. I position size correctly. I place my emergency stop 2 ATRs below. My end of day stop's a close below the 300-day moving average. My trailing stop here, 1.5 ATRs above, and I take partial profits as it moves up. So here we go. That's the trade. I entered at 231.60. The next day it moves up. I hit a profit target. Take a little off, reduce the overall risk. Next day moves up, gets to trailing stop level, which means now if I have a close below a previous bar's close, I sell half. Then we had 2 days down. Here it did close below the previous bar's low, unfortunately, but that's the reason I only sell half, because if I sell half and it goes down from there, I'm glad that I sold half. If I sell half and it goes up, well, at least I still have half. And that's exactly what happened on this trade. So here we reach trailing stop level. Here we close below previous bar's low. I get out for a small gain of 1.31%. Then we move sideways, up profit target, up profit target, up profit target here. Then we have a move down, some sideways motion, profit target here. And in the next few days here, it moved up, but not quite a lot. But then we had big moves here, hit a profit target here. Here I hit 3 profit targets. So anyway, great trade. The remaining shares that I have on this particular trade up 18.81%. But the real takeaway here that I want to show is, look, I was patient. I waited for the signals. But more importantly, I had a very good risk to reward ratio. Look, this was barely above the 300 when I took it. If it had just closed below, it's just been out, right? So this is the key part of trading, everyone, is making sure you have a good risk to reward ratio, because you never know what's going to happen. I was risking a very small amount for, look at this massive, massive move. So now we're up 18.81% on the remaining shares. Google. All right, Google was a short trade that I took over here on the 22nd of November at 138.70. Why did I short? Well, here we have an order block. This is an up bar before a structure change. I got short at 138.70. I position size. I placed my emergency stop 2 ATRs above because this is a short trade. And then my end of day stop. Where's my end of day stop? Very close. Your end of day stop should always be very close. Just simply a close above this order block of 139.60. So I got short here, 138.70. My risk to reward was very good. Any close above here, I'm simply out. I placed my 1.5 ATR trailing stop level 1.5 ATRs below. Next day moves down, take a little profits off. Next day, nothing. Next day, nothing. Next day here, took a little more profit off to the downside, 10%, right? But at this time, the value of 0.45 ATRs minus the close. Then we had another big move down, hit 2 profit targets. Next day, nothing. Next day down here, 2 profit targets, took those off way down here. And then here we have our first close above a previous bar's high. So I exited half of my position here for a gain of 6.25%. Reduced my position size. Then we moved up. And I thought on this day, I thought, well, going to probably get stopped out of this trade. But even if I had, it would have been a profitable trade, right? Because of taking the partial profits, reducing the position size, reducing the overall risk to the downside. And then here, taking off half with the close above the previous bar's high after reaching trailing stop level. Now I really lock in a lot of profits. So the rest of the position, not really going to hurt me. Very unlikely I would have had a losing trade on this because of locking in so much in the profit. But then we moved down, took some more profit targets off, and then really nothing here with the rest. It hasn't moved enough, but Google's been very weak compared to the rest of the market. The remaining shares that I have on this trade up 4.56%. All right, let's move on to the next one here. Walmart. I entered all the way back here, or not all the way back here, on 12/12/2023. Okay, why did I enter this trade? Well, closed under the 250-day moving average, closed over the 250-day moving average. Very easy. Did I know it was going to be a positive trade? No. Overall, is it going to be? I don't know. It is at the moment, but the important thing is that it gives me a very good risk to reward ratio with a very distinct line in the sand. So it closed under the 250, closed over the 250. I got long 151.35. I position sized correctly. I immediately placed my emergency stop 2 ATRs below. Where is my end of day stop? Well, why did I get into the trade? Because it closed under 250, over 250. Therefore, if it closes back under, I just get out. Next day, you can see it was under, but I wait until the close of the day to make my decision, unless it hits my emergency stop. If it hits my emergency stop, I do it immediately. Orange line up here, what is this? This is my 1.5 ATR trailing stop level. Once it gets there, then I tighten up my stop with the rule, if I have a close below a previous bar's low, I'm just going to get out of half, like I showed you over on Caterpillar. So the next day moved up nicely, and I took off a profit target, right? Reduce my overall position. The market can't take that away from me now because I locked some in, reduced the position. Next day we were down. Friday we were up, have not reached trailing stop level, but once I do, then a close below previous bar's low. So this is a very recent trade. With the market being so overbought, I'm looking for moves on the downside of good companies like Walmart that give me good risk to reward ratios. That's the only control I have over this trade. I don't know if it's going to continue to go up or continue to go down, but I need to know exactly what I'm going to do, and I know exactly what to do. If it closes under the 250, I'm simply out. If it hits my emergency stop, I'm simply out. If it moves up, what are we, 152.74? So Monday, I have to add 95 cents to that first profit target. Then I add it again, second profit target. Then I add it again, third profit target. So if it moves up on Monday, I'm going to take some partial profits. If it gets to my trailing stop level, then I go into trailing stop mode. Pretty easy, right? So far, remaining shares on Walmart up 0.87%. All right. I entered a new trade on Friday on USO, which is oil. Why did I do this? Well, you can see the blue, these two bars blue here. This is what's called a bullish abandoned baby. And if you'd like to learn more about these, I have a good video on YouTube. Just go to my YouTube channel, go into the lessons playlist, and look for the title about abandoned babies and island reversals and why they're one of my favorite new setups. Anyway, a island reversal is when you have a big move to the downside. You can see the day before we closed here and we gapped down. Bad news. Well, on Thursday, we gapped up. So we went from a very bearish sentiment to gapping down to immediately gapping up. And these work on both the bullish side and the bearish side. That is a signal. Now, that would have been legitimate to buy on Thursday. I did not buy it there. I bought it Friday intraday when we moved down a little bit, just because I got a better price on it. And a lot of times it will tend to, you see the gap to the left, the gap to the right. A lot of times it will come down, try to fill that gap. I was lucky I got in a good spot here, 66.02. So I have a red line here. I have a green line here. On island reversals or abandoned babies, the way that I do this, I don't phase out. These are just kind of one or the other. I'm either going to, if I'm wrong, hit a 2 ATR emergency stop if I'm wrong. Green line up here is 4 ATR profit target. So regardless of how this works, I'm waiting for a setup that gives me an edge, which is the island reversal. And then I'm going to say, okay, if I'm wrong, I'm going to lose 2 ATRs. If I'm right, I'm going to make 4 ATRs, 2-to-1 risk to reward ratio. That is valid. In addition to that, we have a double bottom bullish divergence. Here we have a low. You see how deep these red bars are? This means the momentum is very strong to the downside. Then we rally into some green bars, and then we make a lower low. We're certainly lower over here than we were over here, but do you see how the red bars here are not as deep as they are over here? This is showing a reduction in the selling momentum. Again, this is one of the strategies that I teach in my course. I did study one-on-one with Dr. Alexander Elder, who is well known for double bottoms, bullish divergences, double tops, bearish divergences. And so it doesn't, just because you have a double bottom bullish divergence, yes, big picture, it is bullish. It is kind of pointing towards that you're running out of sellers, and therefore the implication is that you're going to be going up, but you still need a valid trigger entry to get you into the trade. And my valid trigger entry was on Friday. Again, Thursday was the valid trigger. I didn't take the trade then, but on Friday, as we moved down closer to filling this gap, that is when I got long. And so again, 2 ATR stop to the downside is my risk, my loss risk. 4 ATR to the upside is my potential gain. And this this particular trade so far up 1.77%. And let me show you in the past here some previous double bottoms. Some previous island reversals or abandoned babies, and you can see pretty accurate. They're not always accurate. Look, here we go. Here's an island reversal. Bullish. Was that right? Big picture? It certainly was. Here's an abandoned baby. Bullish. Was that right? It certainly was. Here's a island reversal. Was that accurate? Definitely for a trade it was. And then here we are again, signaling very likely that we're at some type of bottom, although not for sure. But I'll tell you what, I like this trade here a lot better than this trade here. They're both island reversals, but why would I like this one better? Because we have this double bottom, bullish divergence. We also have a ATR divergence. We have an RSI divergence. So this is why I like this trade. So this one up 1.77%. All right, so those are the current open long trades. Now I have a couple of, these are the trades that I closed out. Now, these ones did not work, mainly because of the Fed and their surprise announcement, but it's okay, right? I position size correctly, so I know exactly what my maximum allowed loss is. Here on Rio, we had, again, going back to island reversals and abandoned babies. This was an abandoned baby to the downside. You see how he gapped up and then immediately gapped down. So as we came back up and tried to fill that gap, I got short here 69.91. My 2 ATR emergency stop is above. My 4 ATR profit target is below. And again, just whatever happens, I'm either going to hit my stop, my 2 ATR stop, or I'm going to hit my 4 ATR gain. And got short here 69.91. Kind of started moving my way down here, but then we had the Fed and all this, and this one was a losing trade. Hit my emergency stop, my 2 ATR emergency stop for a loss of 3.81%. So was that 3.81% of my account? No, it was not. It was only 1%. But that happens. You're not always going to get profitable trades with this. But again, if you look back in time of these abandoned babies, oh, I can see one right here. This is a bullish one right here. Bullish, was it correct? Yes. Bearish, 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 was it correct? Yes. Bullish, was it correct? Yes. Unfortunately, this particular trade just didn't work for me. So this one down 3.81%. Closed out for 3.18%. And again, here we go. Oh, sorry, phone call. This also a losing trade on TLT. Again, here is a island reversal, a bearish island reversal. Totally valid. They don't all have to work. So I got short here, 94.54. I placed my 2 ATR stop above, my 4 ATR profit target below. But unfortunately, again, with the Fed, this is what got me there, and I had to get out for a 3.18% loss. So you'll see, not all trades are positive, but what you'll see with my trading is that when they are working, I'm going to stay in them. I'm going to have a process to follow them. When they're not, not working, I'm usually out quick. So real quick recap on the daily trades. Caterpillar remaining shares up 18.81%. Google short trade up 4.56%. Walmart up 0.87%. USO trade up 1.77%. So real nice open profits in the currents. The losing trades, Rio down 3.81% out of that trade. TLT 3.18% out of that trade. All right, let's go over to the weekly time frames. I like to trade both weekly and daily. I like the multiple time frames. And this trade I have been in, it seems like an eternity. I've been in this all the way. Wait, where are we? There we go. All the way March 24 of this year. So I've been this many, many, many months. What do you think? I'm up or down? If I'm in it a long time, it means that I'm up. So why did I take the trade here? Well, weekly time frame, you take action on Fridays. 250 week moving average here. During the week, it slightly went below and then closed above. In addition to that, you have the negative third ATR channel. 92% of prices tend to stop going down when they get to this level, move sideways or go up. So that was my confluence of signals, was the intra-week rejection of the 250. And I got long here at 30.71. I position size. I placed my emergency stop 2 ATRs below. Where's my end of week stop? Just simply a close below the 250 week moving average. Orange line up here. What is that? That is my trailing stop level. So once I get to that, then I go into trailing stop mode. In addition to that, as we move up the value of 0.45 ATRs from the previous bar's low, I take profits. So the next week, I took some profits off. Next week didn't do anything. Next week moved up again nicely, took some profits off. Now I'm in trailing stop mode. We don't get a close below previous bar's low. We have another couple weeks up. And then this is the first close below a previous bar's low. I sold half of the remaining position at 6.4% gain. Then we had a whole nother month to the upside, took some profits, took some profits, took some profits. Continuing to reduce my position size, then we move down, 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 down. Here on this week, the 27th of October, you see how close it got to closing under the 250-week moving average? It did not. It kept me in the trade, and then that next week, monster rally up, took more profits here, took more profits here, and of course this week, took a bunch of profits as well because it was such a strong week up. So the remaining shares on this particular trade up 17.54%. Pretty good. Now, do want to say that we are at a 66.97 RSI. So at this point, one of the rules I was talking about, you see the 5 EMA here? Now at this level, if in the future we close below the 5 EMA, I am simply out of the trade. That's one of the rules that I use. If I ever get to a 65 RSI and then we close below the 5 EMA, I'm completely out of the trade. Alternatively, if we move higher and we reject the 70 RSI, I will sell half of the remaining shares. And then if that happens, then the first time we get a close below a previous bar's low, then I'll completely be out of the trade. All right. So, all right, here we go. Now, Meta is a weekly short. Why did I take this weekly short? Well, look at this high here. You see the strong green bars we have? Then do you see how we pull back to red? Then do you see how we went higher? But you see how there's no green bars whatsoever? So a lot of green bars here. Now we're higher. No green bars here. This is a double top with a bearish divergence. It means that the move back up here, the momentum is slowing, and the implication is we're probably going to head down. But just because we have that doesn't mean I immediately enter the trade. I have to wait for a signal. Well, here was the signal. The week that I took it, we had a V2 entry signal to the downside. If you'd like, I use V2 so much. They're a big part of my trading, both to the long side, to the short side. If you go to my YouTube channel, you can see I have a video there, V1s, V2s. Go check it out. It's totally free. So this was a V2 to the downside. Here's bar 1. Bar 2 goes above bar 1's high. Bar 3 closes below bar 1's close. I got short here at 334.60 in context of the double top. I wouldn't just short any V2, but I shorted this one because of the double top and the bearish divergence. So I position size, my emergency stop, 2 ATRs up here. If I get there, how much do I lose? 1% of my capital. Where is my end of week stop? It's simply a close above halfway of the washout bar. This is the orange line here. So I got short here. 330, 460. Next week went down, took some profit targets off, reduced my position size, have not got to trailing stop level. This week we went up. Look how we got almost right to halfway of that washout bar and then reversed back. So this particular trade, it's so close I can barely even, guess we can do it this way. All right. This trade down 0.08%. So basically just unchanged. But if we, next week, if we close above halfway the washout bar in the V2 here, simply out of the trade. And of course, I have my emergency stop 2 ATRs above here. Johnson & Johnson is a weekly trade that I got involved in on Friday, just yesterday. Why? Well, here we go. Confluence of signals. I always talk about having a confluence of signals. Black line here is 200, a 200-week moving average, very important line in the sand. In addition to that, you can see during the week we went below the 200, but then closed back above the 200. That signal by itself is valid, but I like to look for confluences, and the confluence was, look at the V1. Here is bar 1, here is bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. In addition to that, we had a MACD crossover. You can see the line here, it just started to go green. So those are my confluences of signals. I got long here, 154.72. Currently, that's up 0.7%. I position size, I placed my emergency stop 2 ATRs below here. My end of week stop, well, what was the main reason I took the trade? Because it went intra-week, rejected the 200-day moving, 200-week moving average, which is the black line. Orange line up here, 1.5 ATR trailing stop level. If it gets there, I go into trailing stop mode. But the most important thing right now is in the future, if I close below this 200, I'm simply out. I don't know if it's going to go up. I don't know if it's going to go down, but I have to have a plan so that I know exactly what to do regardless of what it does. So if it goes down here, I get out and lose a maximum 1%. If it closes below the 200, I get out for a small loss. If it moves up, you can see closing price was 155.16, 0.45 values 271. Add those two together, that's going to be my first profit target for next week. Then I'll have my second profit, then I'll have my third. So if it moves up, the value of 0.45 ATRs, going to take partial profits, reduce, lock those in, reduce. If we get to trailing stop level here, then I go into trailing stop mode. So I've got this figured out. I don't know what it's going to do, but I know exactly what I'm going to do regardless of what the market does. And that's what you need to know. You can't just make split-second decisions based upon emotions. You need to have a process that you just follow religiously that uses good trading principles. And again, this is what I teach in my 101 course, and hopefully you're picking some of this up here now as well. So this particular trade up 0.7%. Okie dokie. I have had a few, well, I guess we'll just recap on the weeklies. Remaining shares XLF up 17.54%. Short position on Meta down 0.08%. Johnson & Johnson up 0.7%. So you can see, not all winners. There's losers in here, but the losers are generally small and the winners are generally large on average, and that is how you make money in trading. That is how you make money in trading. So I have had some people email me and say, Greg, could you show us some of your day trades as well using the same principles? And I said, sure. Let's see. Okay, this is a trade that I took yesterday, intraday, on the 5-minute chart on TLT. I got long right here as we triggered a V1. Bar 1, bar 2. Bar 2 goes below bar 1's low, goes above bar 1's close. So this was my entry right here. Now, this is called a higher low V1. Let me point out value zone. the green line here, the green line here. Anywhere in between here is considered the value zone. This particular setup, the rules are, first of all, you need to close below the green line. You need to close below the value zone, which we did. Then you need to rally into the value zone, which we did. Then we pull back and we look for a V1 or a V2. Is this low higher than this low? It is. And it triggered a V1 right here. So this is a higher low V1 in the value zone. So I got long here right about, I don't know exactly what it was, but right here as it slightly went above the close of bar 1, right about 98.81. My end of day stop is simply going to be a close or end of, that's a day trade. So basically right here, this is called the washout bar, the low, the high, halfway, right about here. So such a good risk to reward ratio. I was risking very, very small amount here. Of course, I had my 2 ATR stop below here, but my end of bar stop was just the close below halfway of this bar, right? So close below the value zone, went into the value zone, pull back, triggered a V1, my end of bar stop very close here. Then we moved up here. I took a little bit of the profit off. Then we kind of moved down. Remember, my stop's halfway of this bar. Then we consolidated, moved sideways, had a bar up, took some more profits, had another bar up, took some more profits. Now I'm in trailing stop mode. Anytime we have a big bar up, I'm simply going to take more profits, took more here. Now here we got to the third ATR channel, so 92% of the time, regardless of the time frame, when you get to the third ATR channel, you're probably near a top. And then here was my first close below a previous bar's low after reaching trailing stop level, exited half of the position here. Then we had another big move up where I did take some more profits. And then boom, we had this big down bar here. It was right near close to the market, and I simply got out of the trade. But again, higher low V1, my risk was right here, and look what happened to that trade. So pretty cool, right? Risk to reward. Be patient, wait for your setup, have a good risk to reward ratio, and know how to get out on strength and have a process. So anyway, hopefully for those that were looking for an intraday trade, this was a good example of completely legitimate higher low V2, higher low V1 with a very good risk to reward ratio. That worked out beautifully. All right, let's talk a little bit about trading psychology. This is from Larry Height, very famous fund manager. And what kind of jumped out to me about this post was the risking the 1%, because this is what I do. I risk a maximum of 1% on any one particular trade. By risking 1%, I am indifferent to any individual trade. Keeping your risk small and constant is absolutely critical. So why is this trading psychology? Because if you have a small, if you know what your emergency stop is, at least the way that I trade, I know it's going to be 1%. And I also know that only 5% of the time is it ever going to get there. So it gives you a lot of confidence where you can be indifferent with the trade. And if you have a huge position, you are not going to be indifferent with the trade. If it moves up a little, you're probably going to panic and get out because you have such a large position size. And that's usually going to come back and bite you in the butt, because sometimes these trades, you're going to have monster trades, and you're going to look back and you're going to go, why in the world did I get out there? You got out there because your position size was too large and you were nervous and you got scared and you got out when you had the little bit of profit. Does it make sense? What I have learned in 28 years of trading is if you have a smaller position size that you're indifferent about, just like Larry Height is talking about, by risking 1%, I am indifferent to any individual trade. Keep your risk small and constant is absolutely critical. Guess what I'm saying is you are going to make more money on a small position size than you are going to make with a large position size. Why is that? Because you're going to be able to stay in the trade longer. Yes, if you had a larger position size and you could stay in, sure, you're going to make more money. But human nature being what it is, generally you're going to get scared out and you're going to get out quickly. So remember that. A smaller position size for a longer amount of time is generally going to make you more money than a large position size over a short amount of time. Why? Because you're going to be able to stay in a longer, larger trade. But of course, you need a process that's going to keep you in the trade. So again, whether you follow my process or you follow someone else's process, make sure that you have a process so you know exactly what to do at all times. So thank you, Larry Height. Appreciate that. And we'll read it one more time. By risking 1%, I am indifferent to any individual trade. Isn't that nice? Be just indifferent. I don't care. It's just going to do what it's going to do. Keeping your risk small and constant is absolutely critical. So I hope that was helpful, everyone. All right, let's talk about potential trades moving forward for next week. Now, just want to point out here to everyone that here I have 4 potential trades on the dailies next week. Now, these all could trigger on the same day. It's possible. Does that mean I would take all 4? No, I would narrow it down to the very best one of the day. I've used that process for many, many years of just picking the best one. And what makes the best one? The best one makes the one that has the most confluences of signals, the one that has the best market strength relative to the market, what looks best on multiple time frames. So these are all the things we need to it's kind of like a report card. Okay, you get a point for having this confluence. You get a point for having that confluence. You get a point because the market's the relative strength of that market was better than the rest of the markets. You get a point because on the weekly time frames or the higher time frame, you're also finding some support. And again, this is what I teach in my one-on-one course, in addition to all 5 of the trading approaches that I use. So, if you are interested in you want to become a better trader, to learn a skill for the rest of your life, I think the best way to learn anything is one-on-one with a coach, and that's why I provide the one-on-one stock trading course. And like I said, I have taught people from all over the world, from absolute beginners to completely advanced and everywhere in between. And if you take that course, I promise you, when you are done, you are going to have a skill that you can use the rest of your life. And so anyway, consider it. Send me an email if you are interested. All right, here we go. Let's get started. Alibaba. Well, Alibaba has not participated in the rally here. It's gone down quite a bit. But what jumped out to me on Alibaba is as follows. We did have an under 30 over 30 from Wednesday on Thursday. That was legitimate just by itself. I didn't take the trade, and now we've moved up again on Friday. So even just the single under 30 over 30 so far would have been a profitable trade. But what I'm seeing here is as follows. Here we have a level of liquidity. We ran the level of liquidity, and on Friday, we broke the structure to the upside. So when you have a level of liquidity, basically just a low, you take the low out, then you're waiting for the price to move up over the most recent pivot. A pivot is this bar here, where you have a lower high to the left and the lower high to the right. So on Friday, level of liquidity, we ran the level of liquidity. On Friday, we took out that pivot point, which now puts this Alibaba into a bullish market structure. Now, again, I didn't buy here. I felt like it was a little chasey, but now we have a gap from this low here to 2 days ago high here. You see where I put the lines here? Very likely this is going to pull back a little. Who knows? It might just continue to run up and I miss the trade, and that's okay. But very likely when you come off these under 30 over 30s, you tend to move up and then pull back a little bit before you have a big move up. So what I am looking for next week on Alibaba is simply a pullback into this gap, anywhere from 73.20 to 71.50. So anywhere right in here going forward in the future is where I will enter a long position. And why? Because we had a level of liquidity. We took out the level, and the key point was Friday when we took out this pivot and changed the market structure to the upside. Okay, and again, this is ICT. You can look up ICT on YouTube. He teaches this. But again, this is something that I teach in my course as well. And let me show you. I'll show you an example. And I didn't take this trade, unfortunately. Ugh. Kicking myself, but I just want to put it into context of how similar this trade is. Look at the low here. This is a level of liquidity. We ran the level. This went lower than here. And then here was our first pivot point. This particular bar changed the market structure to the upside. Level, ran the level. This bar here took this out. This changed structure to the upside. So therefore, any pullback after that market structure change into here, into here was your buy. Level, ran the level to the downside. After you do that, this bar took out this pivot. Now we're into a bullish market structure. That was your signal right there. That was your long signal right there between the gap between here and here. And look at that trade. For some reason, I didn't take it. Look at that monster trade. But Alibaba now, if we look back at Alibaba, again, very similar. Level of liquidity, ran the level of liquidity. Friday, we took out the markets. We went into a bullish market structure. So therefore, next week, if we poke our head down into here, that's the buy signal. Position size, I would place my emergency stop 2 ATRs below. Where would be my end of day stop? Simply if we close below these pivots here. So this is one of my favorite setups for next week. I hope that it does pull back here and could be a really good trade. Hey, by the way, if you're enjoying the podcast, if you're finding something valuable, I would really appreciate if you could just hit the thumbs up button. It does help with the channel. It helps out a lot with YouTube, lets YouTube know there's some valuable content here. So if you're learning something today that's valuable, thumbs up would be greatly, greatly appreciated. So Alibaba, we ran liquidity. We changed market structures to the upside. I'm just looking for a little pullback, a little check back into the gap, and if it does, I am definitely going to get long Alibaba. NVIDIA. All right, NVIDIA, you see I have the two orange lines up here. This is a potential short position. Here was an order block. An order block is the highest up bar before market structure change to the downside. We were just talking about Alibaba's market structure changing to the upside. Well, here was a level of liquidity. We ran the level of liquidity. Here we changed market structure to the downside, and therefore I am just waiting for NVIDIA to come back up here to short. Now, this was a legitimate short on NVIDIA here, right now. I didn't take it. I wanted to see whether or not NVIDIA could get a little higher up here. If it does get a little higher next week, I will take the short. I already have shorts. I have Google. I have Meta. So I do already have some short positions, but I do want to get short NVIDIA. And I could have done it because it did reject the order block. I'm sorry, it did reject the order block right here, but I just decided at the end of the day I was going to wait to see if it would go a little higher to give me a little better risk to reward ratio. But next week, if we get higher into this area here, that would be a short. My stop would simply be a close over the order block. Pfizer. All right, Pfizer, well, they had some bad earnings news, kind of in a pre-announcement. You can see we moved down strongly. But in my opinion, Pfizer, I could be wrong, but Pfizer here is probably about as low as it's going to go. We actually had an abandoned baby. You can see we obviously gapped down. And then on Thursday, we gapped up a little bit over that high, making it an abandoned baby. I decided not to get in because the RSI was not over 30. Look, we're at 29.27. We have a technical legit a bullish abandoned baby to the upside, but I decided just to wait for at least for it to get over the 30 RSI. We're very close here. A lot of volume that came in here. In my experience, when a solid company, like Pfizer, has these pre-earning announcements and you're way down like this is something that gets my attention to the upside. It doesn't mean I want to buy right away, but I'm simply waiting for a valid signal, and the valid signal would be just simply a close over the 30 RSI. In addition to that, technically, we had a bullish abandoned baby here as well. So, I try to look for those confluences. By the way, here's the negative third, negative fourth, negative fifth, negative sixth channel. Usually when stocks get down to the negative sixth channel, about 98% of the time, that is it. And you can see on Wednesday, that's literally where we got before we bounced. So just to sum it up, on Pfizer, it does have a bullish abandoned baby, but I'm simply waiting to consider getting in the stock if we close over 30 RSI next week. And then the dollar. Okay, so the dollar, I don't know if you remember, but back over here, the end of October, I was saying that I think the market is going up because I believe that the dollar is going down. Why would I say that? Well, we have a double top with the bearish divergence. Look at this top here. See how tall the green bars are? Then we pull back. Here, we go just as high, no green bars whatsoever. Again, this is showing that the buying momentum is running out. In addition to that, we have ATR divergences, we have RSI divergences. Everything about this particular trade was screaming that we were going to go down. The dollar has, at least at the moment, has an inverse correlation with the market. So basically, the more the dollar goes down, the more the market's going to go up. And that's exactly what happened. And you can see this double top bearish divergence nailed it. And therefore, the market went up. So let's take a look at what's going on now. Now, I'm getting a little bullish on the dollar. Why? Well, first of all, we had an abandoned baby. We gapped down, we gapped up. So that is a legitimate entry long right there. I did not take it. What I'm really looking for next week is, if I'm wrong and the dollar keeps coming down, the 200-day moving average here would be a very, very good entry point. Let's also take a look at some other things about the dollar. Here's the low. Look how how deep the MACD bars are. Then we rally. Are we lower here than here? We certainly are. But you see how we don't have much red to the downside? This is bullish. This is a bullish setup on the dollar, and therefore probably bearish for the market. I'm going to talk a little bit more about what I'm seeing with the markets is why I think we're at the top. But this dollar chart is a big, big part of it. Double bottom, bullish divergence, the opposite of double top, bearish divergences. Here, I was bearish on the dollar, and it was very right. Here, I'm starting to get bullish on the dollar for the exact opposite reason. Double bottom, bullish divergence. So this would have been a legitimate bullish entry on the dollar right here, right now. I decided not to take it. The 200 would offer a extremely good risk to reward ratio down here. But again, just bigger picture is why I think that the market is near a top at the moment is because of the dollar. And look how strong these signals are. Let's see, did I go back further? Yes. Bullish abandoned baby, was it correct? I would say so. Bullish abandoned baby, was it correct? I would say so. Bullish island reversal, was it correct to the upside? Yes. Bullish island reversal, was it correct to the upside? Yes. Bullish abandoned baby, was it correct to the upside? Yes. Bullish island reversal, was it correct to the upside? It was for a while, for sure. Here, bullish island reversal didn't work. They don't always work, but they work more than often. Back here, bullish island reversal. Did it work? Certainly tradable. And then more recently, again, bullish abandoned baby. Is it going to work this time? I don't know, but it works more often than not. So that, my friends, is why I am thinking that the stock market is very near a high because of its correlation with the dollar. This may come back a little bit and the market may continue to go up a little bit, but in the short term, I think we're getting very close to at least an intermediate top on the market, really based upon the dollar. But my entry signal on UUP potentially next week, 200-day moving average would offer an exceptional risk to reward ratio if it gets there. I don't know if it's going to get there. If it does, it does. If it doesn't, it does. But if it does get there, I will definitely be thinking about taking that trade. All right, so real quick recap on the dailies here. Alibaba changed market structure to the upside. I'm looking for a pullback next week, somewhere between 73.20 and 71.50 right in here. That would offer a very, very good setup, very good risk to reward ratio on a very strong signal. Risk would just be close below the lows. NVIDIA, looking for a short up into this fair value gap, looking for a little higher move up, giving me a better risk to reward ratio. Pfizer, bullish abandoned baby in place. I'm simply looking for a close over the 30 RSI. Dollar, very simply looking for some kind of rejection of the 200-day moving average. So that's it on the dailies. All right, on the weeklies now. Berkshire Hathaway, I'm bearish. I'm bearish. Seems crazy in this big, strong market, right? But I am looking, here's an order block before the market structure change between 364.40 and 370.90. We got very close to the bottom of that order block, and that's where it failed. Next week, I'm potentially looking for a short on Friday, somewhere in between 364.40 and 370.90 inside of that order block before we change structure. Exact same trade as the short I took on Google. Tesla, just looking simply for a move back down and retest of the 200-week moving average. I don't know if it's going to get there, but if it does get there, I'm going to take the trade. Look in the past, was the black line, the 200-day moving average, respected? It certainly was. Any close above it was great. Any close above it here, great. So does it mean it's going to respect it next time? Definitely not, but at least it gives you a good structure for your trade to set up. So just to be clear, if Tesla comes back down next week, tests that 200-week, rejects that 200-week moving average, I would consider taking Tesla long. VIX. All right, I was telling you some other signals that of why I thought the market was at least a short-term top is VIX. VIX is volatility, and VIX usually goes the other way of the market. You can see this is weekly. We have gone down for 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. Okay, you can learn to count, Greg. 7 weeks we have moved down on the VIX. And of course, 7 weeks we've moved up in the markets, right? Makes sense. But this VIX chart really jumps out and grabs me and tells me a lot of information about the market in general. Again, VIX usually goes opposite of what the market does. Well, first of all, look at this low here. Look at this low here. If you draw the trend line out, if you get to that trend line, that's generally where you're going to get a bounce in the market. You can see we're very close to getting that trend line. It doesn't mean that trend line will have to hold, but there's a good chance that we'll bounce there. And if the VIX bounces, most likely, not 100%, but more likely than not, the market will go back down. In addition to that, the bullish divergences and all the divergences on the VIX are just screaming at me. Look at the lows we have here. You see how we have red bars? Downward momentum. Well, then we rally into green. Are we lower here than over here? We definitely are. Are there even any red bars over here? No, there is not. So what does this mean if there's no red bars? It means that you're running out of selling pressure. If you're running out of sellers, the implication is you're moving up. So we have a low here, red MACD. We have a low here, no red MACD. That is called a double bottom with a bullish divergence. Let's take a look here. At this low, we are about 3 1/4 negative ATRs. Here we are much lower. We're just 2 1/4 ATRs. That is called an ATR divergence. Let's look at the RSI. The lows over here, RSI was very deep. Now we're much lower over here. The RSI is not as deep. This is a double bottom bullish divergence with a MACD divergence, ATR divergence, RSI divergence. We're coming into this long-term trend line. My guess is that the VIX is close to bouncing. If the VIX bounces, the market is most likely going to go down. So I have all these divergences. Does this mean I want to get into the trade yet? No, I still need a signal. And this is, one of the things that people get confused with. Just because you have a double top bearish divergence doesn't mean you get short. Just because you have a double bottom bullish divergence doesn't mean you get long. You still need a trigger. You still need something to structure your trade with. And for me, it's the RSI. We're at 27.93. I simply need a close above the 30 RSI. That would get me long the VIX. So let's just recap. Berkshire Hathaway, I'm looking for a potential short somewhere in between 364.40 and 370.90 on the weeklies. My stop would just be a close over the high of the order block. Tesla, I'm looking for a pullback to the 200-week moving average. VIX, simply looking for a close over the 30 RSI. And by the way, if we do get a close over the 30 RSI, not 100%, but very likely we would also have a V2, and that would be a beautiful confluence of the signals. A V2 entry trigger, and under 30, over 30 with all the divergences. So, I've been talking about the private lessons that the course that I teach in the evening time via Skype. Again, if you're interested, I love to teach. I've taught so many people, and I know they've been happy with the class. Good goal going into the next year is to invest in yourself. And I promise you, by having 15 hours of one-on-one instruction with me, you are going to learn a lot. So again, my email is in the link in the description. If you'd like to reach out, please do so. The cost of the online or the one-on-one course is $1,750, but I promise you it is worth every penny for what you are going to learn. So if you're interested, just reach out. We'll get the process started. As an alternative to that, I do have a really good online course available on udemy.com. The link is in the description. In that particular course, in my one-on-one course, I teach 5 different strategies, but this is only one strategy. It's called the deep dip buy stock trading approach. If you're not in the financial position to do the one-on-one course, this is a really great, affordable alternative. I teach you step by step all the rules and everything I look for the deep dip buy stock trading approach. I've sold so many of those around the world. I think I have like a 4.9 star rating on that course. So that's a really great alternative. Again, if you appreciate and learn something today in this podcast, if you could hit the thumbs up button, I would really appreciate that. And most importantly, I always like to leave off, please try to go out and do something nice for another human being today. Please try to go out and do something nice for an animal today. If we all did one nice thing for a human, one nice thing for an animal, it really would make the world a better place. And I think we could all use it. So I hope you have a good weekend, everyone. I hope this podcast was helpful. God willing, I will see you next week, and we'll see what happens with this crazy market. But please keep in mind, everyone, that we are at very overbought levels. I would counsel everyone to be a little careful, maybe be be defensive. I think this is a good place to be taking profits up here, and I kind of outlined why with the dollar and so forth and so on. But please be careful. Don't get into FOMO mode. And so that's my parting wisdom with you right now. If you have any questions, please feel free to put them in the comment section. I'll do my best to get to them. But thank you very much, everyone. Appreciate you spending the time, and I hope you enjoy the rest of your weekend. Talk to you next week. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. Rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.